this work, which is jointly authored with a number of partners in crime. So here we have Robert Czech from Bank of England, Shiyang Wang from Hong Kong, and Tianyu Wang from Tsinghua University. And usual disclaimer will apply, as these are our own views and not the views of Bank of England. Okay, so let me get started, and let me try to motivate this paper, in particular the key ingredient of this work, which is FX option volume. Now, I don't need to convince you that over-the-counter derivatives are important for financial markets and for real economy. This is what we learn from any one-on-one class in derivatives. Now, when you think of over-the-counter derivatives, the FX option will immediately come to your mind. Why? Well, because over the last few decades, we have experienced an enormous growth in their liquidity, and by now the FX option market is probably one of the largest and deepest over-the-counter derivatives market you can think of. For example, according to the latest figures reported by the BIS, so the daily turnover is about $300 billion per day, and the outstanding notional amount it's close to 13 trillion of US dollar. Now, there is another reason why we should pay attention to the FX option market, and the reason is very simple. It attracts a variety of market participants. So, for example, we can have the usual suspect like the hedge funds, the asset manager, but we also have large corporation as well as central bank. And finally, there is another aspect that makes FX option particularly interesting to understand price discovery in the FX market. So if you are informed and you want to exploit your informational advantage, you will have an incentive to trade option, because option, they give you leverage opportunity as opposed to trade the underlying spot exchange rate. So overall, it should be important to look at the FX option market. You might wonder why we have not done much to date in order to understand, for example, price discovery in the spot market. The reason is very simple. Getting high quality data on the FX option market is particularly complicated. It's an OTC market, and the terms of a transaction are typically only available to the party involved in the transaction. Now, when you think of the FX market more in general, we have seen a number of papers focusing on more granular data, especially when you think of other segments of the FX market. For example, there are a number of papers that have used granular data to better understand trading activity, liquidity conditions, for example, in the spot market and in the forward market. I think of the paper by the recent work by Cespa, Gargano, Ridio, and Sarno, where they try to understand whether FX volume can predict future exchange rate returns. So they find evidence of price continuation. So what they show is that FX volume per se cannot predict future exchange rate return unless you condition on the past exchange rate return. And then, like we also, we have the paper by Mancini, Ronaldo, and Brampiler. So they look at the liquidity condition in the FX market. You have also other papers, they look at heterogeneous information. Yeah, you have other papers that look at price dispersion. I also have a paper with Tianyu Wang and Chenedese on this topic. But then when you think of the FX option market, there is very little out there. So what you typically learn is that price discovery is very much unexplored in this market. And the reason, as I said, is because high quality data are very difficult to collect. So what we want to do in this paper is to understand whether FX option, and we're going to do that FX option volume, we're going to do that using a granular data set, which comes from Bank of England, is an important source of information to pin down the value of a future exchange rate. So let me try to summarize briefly what we have done and what we have found so far in this paper. So first, we build a simple model that allows us to generate a number of predictions linking FX option volume to future exchange rate returns. So the model is very simple. It's a suggestive model. It's not a quantitative model. And then we have taken the prediction of our simple model and test this prediction using a unique data set that comes from Bank of England on over-the-counter FX options. So just to give you an idea of what we have in our hands, we have more than 1 million transactions where we observe counterparty identity and contract characteristics. So it's, you know, it's really the first time that academics have managed to get such a rich data set. And in terms of empirical finding, we do observe that there is a negative correlation between FX option volume and future exchange rate return. What do I mean? I mean that when option volume is high today, it's likely that the foreign currency will depreciate tomorrow. And we find that this negative correlation between FX option volume today and exchange rate return tomorrow is particularly strong when we condition on the FX option volume of hedge funds and real money. Okay, so basically what we argue is that this negative correlation gets stronger when the market is populated by informed investors. And typically in the FX literature, hedge funds and real money are regarded as informed investors. We also find that this negative correlation is more pronounced during periods of high dollar demand. Think of periods of flight to safety, when it's more valuable to hold dollars in your pocket. And finally, you know, when you condition on the volume of options that give higher embedded leverage to investors. So in this case, you know, the negative correlation is more pronounced when you look at short-dated option as well as you know, out of the money or deep out of money options, because short-dated and out of money option provide higher embedded leverage to market participants. So in a nutshell, so this is what we have done so far and what we managed to empirically find in the data. Okay. So if there is any questions, more than happy to take a question on this stage. Otherwise, I can move on.
There aren't any questions in the chat right now.
I would have a question.
Hi,
Hi, Pasquale. Is this
Hi.
all from the perspective of a US dollar investor?
Yes.
I'm a bit puzzled. I mean, you can see in the equity literature why volume might relate to a certain direction, but this currency pairs is all two-sided. Why? What's the intuition why more volume goes in the one direction?
Correct. And that's why we need to have a model. Okay, let me give you a straight answer to that. So what we show in the model, and then we verify in the data, is that option volume is more likely to reflect bad news about the foreign currency as opposed to reflecting good news about the foreign currency. So vice versa, option volume is more likely to reflect good news about the dollar and bad news rather than bad news about the dollars. Okay. And I'll try to be, so otherwise I would agree with you. So that's why we build a simple model, because otherwise it would be very difficult to reconcile, you know, the direction of volume and the direction of the exchange rate, because of course, like, you know, the dollar might appreciate or depreciate when the volume is high. Okay, excellent question.
Small question from Stephen Chen. Can you differentiate the volume for the out of the money calls or puts? I guess for the out of the money versus at the money calls or puts.
Yes, we can do that. Yes, we can do that.
So you do. So actually, let me follow up with that. So you actually have the volume in. You know, you have the volume in every contract. You know the contract characteristics.
Exactly. Yes. We do. We have a related exercise which I will try to briefly present towards the end of this talk. Okay.
And Pasquale, the high volume on out of the money calls predict negatively just as the high volume on out of the money puts.
Good question. So I don't think we have probably done this exercise. So what we do, we have aggregated option in terms of moneyness. And what we show is that, so out of the money, put and call, depending on we know which market condition you are, can predict exchange rate return better than in the money options. So what I remember off the top of my head is that in our sample, the volume of put option is higher than the volume on call options. Okay, but I understand what you're asking. You're asking to separate the exercise and only focus on put as opposed to combining together out of the money call and put. That's an excellent question. We can certainly provide more details on this.
Thank you.
Thank you. Okay. Right. Okay. So now let me briefly give you some insight on the model. So the model is, as I said, is a suggestive model. Is super simple. So we have a one-period model which builds on Hensley and Coulter. So we have a risky asset. In this case, the risky asset is a unit of the foreign currency, which is priced in dollars. Think of the euro, just for the narrative of today's presentation. For simplicity, we assume that interest rates are zero. That means that investor can decide whether to trade in the spot market or in the option market. We don't have a forward contract in the model, but then I will show you a related exercise with respect to forward contract. Then we have risk neutral market makers, and they have zero expected profit. So then we have two type of investors. As usual, we have the informed one, and then we have the uninformed one. So the informed one, they have private information about the future value of the euro, of the foreign currency otherwise, and then they trade for information reason. And then we have the uninformed investors. They can trade for any liquidity reason, which is exogenous to our model, and they infer the future value of the euro using publicly available information. Now, there are two...
So can I jump in with a question here? I'm sorry to interrupt.
No problem.
So my memory of the Easley, O'Hara, and Srinivas model is that in that model, people don't really care about the payoff of the option. They trade the option because it provides them better leverage.
Yes.
Right. But I mean, I know you don't have forward contracts in your model, but in the actual FX markets, there are forward contracts that provide even more embedded leverage, right? You loosely infinite leverage with forward contracts.
Well, it depends on the collateral.
Sorry?
It depends on the margin that you have to post for your...
Okay, I understood, right? Not infinitely, but there's another mechanism, another contract that also provides embedded leverage.
Correct. No, there are, so there are, the reason why we don't use forward in the model is just to keep the model simple. And I will show later in a related exercise. So we have a similar granular data set on forward contract, and we show that forward volume does not provide any valuable information to forecast future exchange rate returns, and our findings are in line with the work of Czech and Coulter. Okay, but you're right. Potentially you can also have forward contracts that could play a role. Okay, so now there are two elements that I'd like to stress. One, Neil, as you mentioned, is leverage, and so we know that leverage, can potentially increase your potential profit. We know that leverage is higher for out of the money and short maturity option. And our formulation of leverage is pretty standard. It's just the elasticity of the option price relative, to the price of the underlying asset. And so it's in line with the existing leaders. Think of the paper by Johnson and So, Frazzini and Pedersen, so on and so forth. And then the other aspect that I'd like to stress in with respect to this paper is the existence of dollar benefits. What do we mean? So we assume that investors, for whatever reason, they extract private benefit from holding dollars, or if you like, dollar denominated asset, and vice versa. They are gonna face a utility loss whenever they sell dollars. Now, these are, these dollar benefits are completely unrelated to private information. They are related to the future exchange rate return, And we try to motivate like these assumption, by building on this extensive literature on the importance of the US dollars for international transactions. So to be clear, it's not macro-funded. We simply assume, building on the existing literature, that investors, everything else being equal, they would prefer to all dollars or dollar-denominated asset. Okay. Now, what do we? I can skip this. This is just like the structural trading. I think it's probably less important in the interest of time. So what do we predict with our model? So the main result is simple. We say when option leverage is low, informed investor will have no incentive to trade option. You can expect that options are probably more expensive to trade than the underlying asset. So in that case, whenever option leverage is low, informed investor would prefer to trade spot contracts as opposed to option contract. And in our model, when this happens, the covariance or the correlation between the exchange rate changes between today's and tomorrow and the option volume tomorrow is going to be zero. In other words, option volume is pretty much an informative about the future exchange rate return. Now we can consider the other extreme case where option leverage is high. So in this case, informed investors, they will actually prefer to trade the option contract. But as Tobias highlighted before, high option volume today might imply, an appreciation or a depreciation of the foreign currency. And this is where, the dollar benefits will come into play. So our model predicts that the correlation between the future exchange rate return and option volume today is negative when dollar benefits are high. Now, let me try to explain this mechanism, which is very intuitive. So when the dollar benefits are high, and in our model, we mean they are higher than the trading profit that you obtained by trading option. So in this case, as an informed trader, you are reluctant to buy the euro, say by buying a call or selling a put, when you have good news about the euro. So if, alternatively, so if, for example, dollar benefits are low or close to zero, and you have a good news about the euro, of course, you would have an incentive to load on the euro by buying a call or selling a put. Vice versa, and this is what our model suggests, when dollar benefits are high, so you are reluctant to trade, okay, on good news about the euro to the option market, because otherwise you will lose this private utility coming from holding US dollar, okay? Vice versa, when you have bad news about the euro, you are more likely, to buy a put or short a call, because then you can combine the dollar benefits plus the potential profit coming from your derivatives trade. And so with this mechanism, so what we have is that the option volume is more likely to reflect negative news about the foreign currency rather than positive news about the foreign currency. Or if you like, the FX option volume is more likely to reflect good news about the dollar rather than bad news about the dollar. To give you a different example, imagine that you have short sell constraint. So if you have short sell constraint on an asset, then the asset will only reflect good news rather than bad news. Because whenever there are bad news, short sellers cannot short the asset. So the intuition is similar. And so in the end, what we can reconcile with what the model suggests is that there is a negative correlation between option volume today and the future dynamics of the exchange rate return. Okay, so I can try to summarize everything with this simple diagram. So we have the dollar benefit, and then we have the option leverage. And so to sum up, when the option leverage is low, informed investors will only trade the underlying asset, and the covariance between exchange rate return and volume today is zero. On the other hand, when option leverage is high, informed will trade options. However, only when the dollar benefits are high, there will be this negative correlation between option volume today and the future exchange rate return. Okay. When dollar benefits are low, however, we cannot extract any valuable information from option volume, because in that case, if there are good news about the euro, investors will buy call or sell put options. So in that case, we can observe high volume, but this high volume is not informative about the future exchange rate returns. Okay, so this is what our model suggests. So to sum up, what we find is that there is a negative correlation between option volume and exchange rate return when dollar benefits are high, because in this case, the volume will only reflect negative news about the foreign currency, and the option leverage is high. Now, this is a simplified version of the model that we have in the paper. We also have an intermediate case, which is described in the paper. But, just wanted to make the key point about this paper. Okay. Any questions at this stage?
Nothing in the chat.
Okay.
Right?
Okay, thank you. Right. Okay. So on the basis of this model, we can extract three empirical predictions, and the predictions are the following. So there exists a negative correlation between future exchange rate return and current option volume when we have a higher concentration of informed investor, when dollar benefits are higher, and when the option leverage are greater. Okay, so these are the three main predictions that we will try to verify in the data. Now, let me spend a few words about our data set, which is an important ingredient of our exercise. So as I said, we use a highly granular data set. And long story short, so these data are the result of the EMIR regulation. This is the European Market Infrastructure Regulation. So for those that are not familiar with this regulation, so in Europe, since 2014, legal entity have an obligation to disclose and report the terms of any derivatives transaction to a trade repository that is authorized by the ESMA, and these transactions are then made available to supervisory authorities. In our case, we managed to get the data from the Bank of England, and the Bank of England is a supervisory authority. And now what we observe, we don't observe the entire universe of all transactions. We only observe those transactions where at least one of the counterparty is a UK legal entity. Okay. Now the fact that London is the global hub for FX, it means that most of the transactions will be covered by our database. In fact, when we aggregate transaction volume at 4 p.m. London time, and we compare our statistics with those provided by the BS, what we conclude is that we cover, roughly 42% of the global trading activity. And I can briefly show you this chart.
Actually, let me jump in. I was a little bit slow. There's a question in the chat that's really about the model. So let me jump in before you get too far. Yeah. From Stephen Chen. But based on the theories, options traders may hedge the USD benefits or foreign currencies by trading options, which may also make the option volume higher. I mean, I think, I'll let him jump in and correct me, but I think he's suggesting that there's a hedging reason to trade the option, to trade the options.
Correct. Potentially, there could also be an hedging reason. Now, of course, to discriminate in our data set, we should observe the entire portfolio of the trader, which we don't, right? So we can't discriminate whether options has been used for hedging or is a naked FX option. It's a valid point, but we don't really observe the entire portfolio of the market participant. Excellent point.
Sorry, I'll jump in since I think it's related. So what you have is signed volume, right? So when these investors are buying or selling, right?
Okay, that's a good question. So we have an exercise because we only observe signed volume for a subset of our transaction. So for the full data set, we don't have a signed volume. We only observe that there is a transaction between A and B, okay? But then for a subset, we also know when a client is buying or selling, okay?
And in that subset, do you know? Oh, I think you answered that already. You don't know if they are buying or selling to open or to close a position.
Exactly. Exactly.
Nice.
Okay, just to show you some numbers here. So here, the red bar shows the average volume of all dollar pair traded in London. So these data are provided by the FX Joint Standing Committee at the Bank of England. And the green bar, so these 91 billions of US dollar per day, is the corresponding dollar volume that we observe in our data set. So as I said, we can match the survey compiled by the FX, London FX Joint Standing Committee. And if we compare these 91 US dollar, these 91 billions dollar per day to the number provided by the BIS. So for the BIS, reports 218 dollar billions per day on all dollar pairs. So we conclude that we roughly observe 42% of the global trading activity. Okay, so we think that is highly representative. Then, as you probably know, there are two segments of the market. There is an interdealer market and there is a customer segment. So we identify 17 dealers in our data set, which spans 2 years. It goes from 2015 to end of 2016. So we have 2 years of data for about 1 million transactions. So first we identify the dealers, and then we can pin down transactions between dealers and counterparties. So since we observe the identities, we group customer transaction into 4 categories. We have the real money. So we pull into the real money asset manager, pension funds, so on and so forth. Then we have hedge funds. Then we have non-dealer banks. And then we have other clients where we pull together corporates, central banks, monetary authority, so on and so forth. Okay, so these are the 4 categories that we have on the customer segment. Just to give you a few just to visualize some information about our volume. So here we can do a breakdown by counterparty. So we have the interdealer transaction, which in our case is about 2/3 of the volume, and then we have the rest is between dealer and client, and the client-to-client segment is pretty tight. Now, one thing that I'd like to stress is that with our data set, it's very likely that we overestimate the interdealer volume, and we underestimate the dealer-client volume. To give you an example, imagine that you have Ferrero, an Italian-based company. Ferrero might trade with UniCredit, and then UniCredit might trade with, say, JP Morgan in London. We only observe the transaction between JP Morgan and UniCredit, but we don't observe the transaction between Ferrero and UniCredit. Okay, so in the end, we might underestimate the client segment. And then when we zoom into the dealer client segment, what we find is that most of the transactions are undertaken by real money and hedge funds, and to a lesser extent by regional banks, which we call non-dealer banks, and other clients. Okay, so in other clients we have corporate firms. The reason why we don't have a separate corporate segment is because we don't observe lots of transaction undertaken by corporate in our data set. Okay, just to be clear. Right. Okay. So we have 20 currencies. The truth is that most of the volume is spread across 7 major currency pairs, which are the Aussie, the Canadian dollar, the Swiss franc, so on and so forth. Let me show you some numbers in terms of volume by currency pair. So the blue bar is the total volume, the red bar is the interdealer segment, and the green bar is the dealer client segment. As you can see, most of the volume is spread on usual suspect. You have the euro dollar, the pound, and the yen, but we also have a substantial amount of trading activity on the Australian dollar or like, the Canadian dollar. There is very little that we observe, for example, in currencies like the SEK and the NOK. This should be expected because these currency are mostly traded against the euro, not against the dollar. So that's why in our sample, we don't observe, a large number of transactions, these two currency pairs. Okay. How do we measure now volume? So what we do, we observe transaction volume, across different transactions, and we aggregate all these transaction volume in dollars at 4 p.m. London time for each currency, and then we follow like the recent literature. We try to account for linear trends and heteroscedasticity, and we follow the work of Chespa et al. So what we do, we take the log option volume for a given currency pair today, and then we subtract the past month average volume. So in the end, we have, we can come up with a measure of abnormal option volume, which I'm gonna call little VIT, and this is what we are gonna use for our empirical exercise. Okay, so we start from transaction level volume. We aggregate volume on each day at 4 p.m. London time. We account for heteroscedasticity and linear trend, and then we use this measure of abnormal volume for our empirical analysis. I haven't told you anything with respect to the exchange rate. So we construct exchange rate returns by sampling, okay, at 4 p.m. London time, spot exchange rate from Refinitiv tick history, and then we construct, the daily exchange rate return using the log of the spot exchange rate today at 4 p.m. minus the log of the spot exchange rate at 4 p.m. on the day before, as simple as it gets. Okay. And okay, now let me jump immediately into the empirical evidence, and let me show you a few results on hypothesis one, just to recall the audience. So our first hypothesis suggests that there is a negative correlation between option volume today and the future exchange rate return tomorrow, when we have more informed traders populating the option market. Okay. Now, I'd like to stress that our objective is to evaluate the economic value of the information that we can extract from FX option. Okay, we don't really want to offer a measure of profitability, and the reason is fairly simple, because these data are not publicly available, and so they cannot be used by an investor. Okay, now to assess our empirically our first hypothesis, we are going to do something extremely simple. We are going to form a portfolio sorted on our abnormal option volume. So on each day T, we form 4 baskets, so that in the first basket, we have currency with low abnormal option volume, and in the last basket, we have currency with high abnormal option volume. And then on the day after, we can take the average return in each basket, and then we can also construct the average return on the low minus high portfolio, okay, which in this case would be P1 minus P4, and we're going to refer to this portfolio as L minus I volume, okay? And we do this exercise for total option volume for the interdealer segment as well as the client segment. Now, let me drive you through our exercise. So we run these portfolio sorted analysis using both, the large cross section of currency pair as well as a subset of liquid currency pair, which are the G7, as I mentioned before. So I'm gonna present our results for major currency pair, and something else that I'd like to stress. So in this table, we are gonna focus on exchange rate returns. We are not using any interest differential, or if you like, excess return. We also have an exercise where we look at excess returns, but results are, fairly similar, suggesting that any positive numbers that I'm going to show you, it's driven by the exchange rate return and has nothing to do with the underlying interest rate differential among different currency pairs. Okay. Now in the top panel, as I said, we look at the overall option volume. So we have P1, so this is the basket of low option volume. PI, this is the basket of high option volume. And if we buy...
Can I ask a clarifying question?
Please.
So what are the units? In the upper left-hand corner, 2.26, what? 2.26 basis points?
No, percentage per annum. These are percentage per annum.
Per annum?
Yes, yes.
Okay, that's why they're so big. All right, thank you.
So this is 2.26% per annum. So if we build a low minus high strategy, we obtain an average exchange rate return that is about 15% per annum, of course, before transaction cost and any other additional cost that might affect this strategy. And this number is statistically different from 0 because the T-stat it's larger than 2. Then we can also look separately at the interdealer as well as the client segment. When we look at the interdealer, the low minus high is about 12% per annum, and is just close to being statistically different from 0. So the T-stat is just close to 2. And then when we look at the interdealer, so the dealer client segment, we have an average exchange rate return that is about 17%, and the T-stat is largely above 2. So when we look at this type of exercise, what we conclude is that high option volume will generate negative exchange rate return tomorrow, whereas low option volume will be associated with a positive exchange rate return tomorrow. And then we also find that it doesn't matter if you look total or if you look the interdealer or client segment. We tend to observe this negative correlation between exchange rate return and option volume, which translates into a positive average return on our low minus side. But at this stage, of course, one might wonder whether the information comes from the interdealer, whether it comes from the dealer client segment. And we know from the extensive literature that dealers, they care very much about their inventories, so they trade with their customer base and then they manage their inventory, whereas clients, they're more likely to trade either for informational reasons or for liquidity reasons. So to answer this question, what we do, we run a simple panel regression exercise, and we also control for the volatility, which is based on 5 minutes level return, for bid ask spread, as well as for forward premium. Now, when we look separately at total volume, dealer deal and dealer client, we can reconcile our panel estimates with the previous result. However, when we stack together interdealer and the dealer client segment, what we find is that the information, at least in our exercise, seems to arise from the dealer client segment, not from the dealer segment. So in other words, so when you condition solely on the interdealer segment, you might find positive results just because the interdealer volume mechanically reflects what happens on the client segment. But once you stack everything together, the interdealer volume is going to lose its statistical significance. And results remain fairly similar once you control for the interest rate differential, realized volatility, and bid ask spread. Okay?
Pasquale, a quick clarifying question on that table.
Yes.
So not this one, the regression table.
Okay.
Yeah. So is it a typo somewhere, or is the R square constant? And if the R square is constant, I'm assuming it's coming from the time fixed effect.
Yes, no, this is a total R square. Yes, it's mostly from total R square. Yeah, correct. Yeah,
Okay.
I think it's the 4-digit that is changing. I can double check, but it's the 4-digit. Yes, this is a total R square. It's not the within R square.
Okay.
Okay, so there's, sorry, go ahead.
No, I was going to give you the
All right, so another question is from Stephen Chen. Do you control for the risk appetite for the cross sections of the currency pairs? I am asking this because USD tend to appreciate if the markets have higher risk aversion, which also results in more options hedging?
That's a good question. We have an exercise. We look at the dollar sensitivity. We look at the beta exposure, and then we construct buckets. We find that the effect is the same across all currency basket. Yes, we've done that. That's an extremely fair point. I'm not presenting in these slides for the interest of time, but we've done that. Yes. Okay. If there are no questions, maybe I can quickly move to the next table. So in the next table, now, so far, I've tried to convince you that most information comes from the client segment. Then the next step is to try to dig a little bit more into the client segment, trying to understand whether the information comes from all market participants or from selected group of market participants. So in this case, now we're going to categorize, as I said before, our option volume into the hedge funds, real money, non-dealer banks, and other clients. And when we do this exercise and we focus on the average return on our low minus psi strategy, what we observe is that there is statistically significant evidence that information comes from the hedge funds and from real money, okay, and not from non-dealer banks and other clients. And this could be in line with the recent literature on FX market structure, suggesting that hedge funds and the real money are more likely to trade on information. Of course, I'm not claiming that they are insiders. They are more likely to process better than other market participants information that is dispersed out there. So think of them as being skilled market participants. So they acquire information, they process information, and they can better, trade on this information. Okay. So yeah.
Pasquale, would you have the information and is the data rich enough so that you could split the hedge fund in essentially two groups? A group of hedge funds whose business would be to speculate on some information related to currencies, and maybe another group of a hedge fund whose core business would more align towards hedging with the options?
Okay, that's a good question. So we don't have access to this information. We should dig a bit more, meaning that we should identify the hedge fund, and then they look at the prospect of their strategy, try to guess whether they are more on the hedging side or the speculative side. Okay, that's an excellent question. We can try to figure out whether we can do it. We don't have immediate access to this type of information.
Thank you.
Thank you. I will skip this, and since I have only 6 minutes, let me jump into the second hypothesis. The second hypothesis that comes from our model is fairly simple. It suggests that the relationship between option volume and exchange rate returns is stronger when dollar benefits are high. Okay, and the way we measure dollar benefits in our exercise is fairly simple. We rely on the CFP deviation. In this case, we look at the spread between US dollar 5-year bonds and the corresponding foreign bonds hedged with respect to their currency exposure. So to some extent, we are using the CFP deviation. And the idea here is to differentiate between periods where CFP deviations are high and periods where CFP deviations are low. Because the idea is that when CFP deviations are low, it's more likely that investors value more having dollars in their pocket. Or if you like, these are periods of high dollar demand, as opposed to periods of low dollar demand. So when CFP, in absolute terms, are above the average, as opposed to the case where CFP are below the average value. So when we discriminate between periods of high and low dollar demand, so what we find is that the average exchange rate return on the low minus psi portfolio is statistically different from zero only when we have high dollar demand periods, and not when during low dollar demand period, which is in line with what our model suggests. So in other words, dollar demand is high during periods of flight to safety. Okay, just to to put in different words. And in alternative to using the US Treasury premium, we also use the VXY index, which is the equivalent of VIX index. Once again, when the VXY is above the average value, we identify periods of high dollar demand. When it's below the average, we identify periods of low dollar demand, and the results are fairly similar. So we find that the average return on our low minus side is different from zero, statistically speaking, only when we have high dollar demand periods, okay? Vice versa, during low dollar demand periods, we uncover statistically significant elements. And finally, let me jump to the third hypothesis. I'll skip these couple of slides, which are in the paper. So as I mentioned before, you might expect that leverage opportunities tend to be higher for short-dated option as well as for out-of-the-money option. And our model suggests that the relationship between volume and the exchange rate return is more pronounced for options that provide greater leverage opportunities. So here we do two exercises. One is based on the level of moneyness, and the second one is based on maturity. Let me focus on the first one. So we look at the level of option moneyness, which we use as a proxy for option leverage, and then we build up 5 buckets. We have deep out of the money option, near the money, in the money, and deep out of the money. We repeat our long short exercise, and what we observe is that the average exchange rate return on the low money side is particularly strong is particularly high for deep out of the money option and for out of the money option, but then it immediately disappear statistically when we look at near the money and in the money option, which is in line with what our model suggests. An alternative exercise is to look at option maturity. So we're going to create 4 buckets. We have maturity up to 1 month, between 1 month and 3 months, and then we have options that have maturity between 3 and 6 months, and options with them a longer maturity. And in this case, we find that most of the results are driven by short-dated option, mainly option that have a maturity up to 3 months. So less than or equal than 1 month, and option with a maturity between 1 month and 3 months. For longer dated option, we don't really uncover strong evidence that option volume can predict future exchange rate return. I have 1 minute to combat. Before I jump to the conclusion, let me show you the exercise that we've done using FX forward volume, because as I said, in our model, we assume that interest rates are 0. And so we have access to transaction level forward and FX swap contract. So we can construct the volume also for this other segment of the FX market. We repeat the exercise. In particular, we focus on the dealer client forward volume. And what we show is that when we construct this low minus size strategy, we are unable to find any statistically significant evidence that FX forward and swap volume can predict future exchange rate return. Okay, these results are not surprising because are in line with what Chasman and co-authors have already documented using a different data set which comes from CLS. So in this case, our results are in line with their findings, even though they have a different models. And then we have other exercise where we look at the Bloomberg data. So Bloomberg offers access to transaction level options, but these data are anonymized, so you cannot discriminate between dealers and clients. And when we look at the aggregated data, we can to some extent reconcile our findings with Bloomberg data, but our data set is much richer, and it allows us to provide additional evidence. So to conclude, So in this paper, we try to evaluate the economic value of information that you can extract from FX option volume. And in particular, we do this exercise because we want to understand whether option volume can predict future exchange rate return. You know, for our exercise, we first build a simple model that delivers 3 empirical predictions, and then we test this prediction using a novel yet highly granular data set. So to sum up, we do find that high option volume today predicts a depreciation of the foreign currency tomorrow, and this happens when we condition on the transaction undertaken by informed investors during periods of high dollar demand and for options that offer greater leverage opportunities to investors. And I think I'm going to stop here since I've used all my time. Thank you.
Great. Thanks very much. At this point, I'd like to invite anyone who has a question to feel free to unmute yourself and use your microphone and shout out your questions.
Thank you. Okay, I will take note.
No questions. Well, people ask questions, some questions during the talk.
Yeah.
Last chance you could tell. Last chance to tell Pasquale he's wrong. Explain the mistakes he made.
No, any suggestion is very welcome at this stage. And of course, you know, you're more than welcome also to send us some emails if you want. I mean, this is just part of a research agenda, and it could be that, like, you know, there's you know lots that we can learn from this data. So, you know, comment suggestions are very welcome. You can also send me an email later on.
Excellent. Well, on that note, thank you very much, Pasquale. It was a very interesting talk. Thank you very much to everyone who attended it. We hope to see you in 2 weeks, November 2nd, when Eben Lazarus is going to, yeah, it's in 2 weeks, is going to present. So on that note, a great end of day, everyone, and see you then. Ciao.
Thank you. Thank you. Thank you so much.
Bye-bye. Thanks very much.
Bye-bye. Bye-bye.